Hi, and welcome to the Money Minder podcast. I'm Ray Black, Managing Director of Money Minder, and I'm once again fortunate enough to be joined by Melvyn Prior, long-term former BBC presenter. We're going to be discussing what's going on in the markets, budgets that are coming up, and anything else that Melvyn decides he wants to ask me questions about. We don't have agendas for these meetings. We just generally have a chat, and hopefully you'll find some of it and most of it really interesting. Melvyn, over to you.
Thank you. Yeah, well, we've got the budget to talk about in a moment, but I thought we'd start this month with interest rates. There's a lot of talk about whether rates will come down. They seem fairly static at the moment, though, don't they?
Yeah, they do. And there's a reason for that. We are constantly told the rate of inflation on the news that is what they call the CPI rate of inflation, consumer price inflation, which currently stands at 3.8%. So the last meeting, they'd have said, oh, inflation's at 3.8%. Those stats come out from the ONS. Bank of England's target is 2%. However, that 3.8% on CPI doesn't include housing costs. So the only way you get an inflation rate close to CPI is if you don't have a house, not rented, not mortgaged, not owned outright. It's CPI not including housing costs. When you put housing costs in, it becomes something called CPIH, CPI with housing costs. That's the measure that actually we would expect generally the Bank of England to take more notice of. And in my personal opinion, that's the one that at the very least we should be looking at because it includes housing costs.
That's currently most people's major outlay, isn't it? That's most people's major expense.
If you've got a roof over your head, you've got to pay for it.
Yeah.
So CPIH 4.1. If you go to the original measure of inflation that Gordon Brown moved away from in late 2003, early 2004, when Melvyn King, the Bank of England governor at the time, wanted to put interest rates up because houses were getting a bit expensive. Things were getting out of control on the housing. And the Bank of England governor at the time said, we really ought to put interest rates up just to curb everybody's spending on houses. But at that point, we were 18 months away from a general election. Probably wasn't what Gordon wanted at the time. But him and Tony had given Tony Blair had given the control of interest rates to the Bank of England on the basis that they have their finger on the pulse more about what's going on in the economy. And it should be an independent decision, not a political one. Well, of course, putting interest rates up just before a general election never goes down well with the voting public. There wasn't anything that he could do about it because Bank of England had control. But what he could do at the time was change the measure of inflation. So we went from what was RPI, Retail Price Index. A lot of the old public sector pension schemes and various other final salary schemes always used to go up with RPI, Retail Price Index. From 1947 right the way up to about 2003, 2004, that was the standard measure until it wasn't. RPI at the moment is 4.6. So there are three measures of inflation to be considering. CPI, no housing, 3.8. That's the one you get told about on the telly. 4.1, CPI with housing costs. That's a much truer example because you've now got some housing costs in. If you've got a roof over your head, you need to pay for it. But the one that I tend to be more in tune with, and there's still speculation that it's undercooked, RPI 4.6. Back to your point, you asked about interest rates. Bank of England put interest rates up to curb people's spending and to increase the cost of borrowing, so that we're not all rushing out for a meal at the weekend to go for a pint and spend all those lovely times shopping around for presents and new clothes and that kind of thing, because things are just a bit tight. So when the economy is bubbling along quite nicely and pushing forward and the things are getting more and more expensive, it's a very blunt tool, but to curb spending, you put the cost of borrowing up. If you want to encourage spending, in a recession, in a technical recession, in periods of a flat economic period, that kind of thing, what you do is you put interest rates down. That reduces the cost of borrowings. people's mortgages and loans, credit cards, they don't cost quite as much. And it encourages people to go back to the pub, go out for a meal, buy some nice presents for the kids, have some new clothes at the weekend, because their costs aren't quite so high. So Bank of England are in a really uncomfortable position at the moment. Their target for inflation is 2%. If you include housing costs, it's over double that at the moment. And if they reduce interest rates at the next meeting, and a lot of people thought they were going to at the last meeting, but it was a difficult position. If they are going to reduce interest rates, and there's a potential that it will spur inflation even further, which they really don't want, because we're currently living over 5 years with a cost of living increase compounded, not at 3.8%, but actually 5 years, it's more like 37, 38%. So, example, a loaf of bread 3 years ago, January 22 or so a little bit over 3 years ago, the average bog standard value loaf of bread was £1.08. It's now £1.40 on the ONS statistics. That's a 30-odd% increase, about 37% overall. So
we've talked about this before, haven't we? The fact that the only way things will get better is if we eventually have some sort of deflation, because every year it's putting more and more on each year, isn't it?
Yeah, it is. Deflation is also not a very nice place to be either. And the reason that deflation isn't a very nice place to be is because if you need a new TV and you're absolutely confident that the TV that you absolutely love at the moment is going to be cheaper next year than it is this year, why would you buy it this year? Just wait, unless you really have to. But people stop treating themselves to some of those things because they're not worried about it going up in price. They're more expecting it to go down in price. That's a deflationary pressure. And if you're not buying that new TV, what happens to the TV manufacturer with all that stock on the shelf? No one's buying it because they're waiting for it to get cheaper.
So hang on, we don't want inflation or deflation then, do we?
Not really. No, we want nice steady inflation. What we want is a cost of living that perhaps goes up 2.5%. That's all right. We can cope with that. Most people, it's still devaluing the currency. It's still devaluing the pound. Think about it this way around. I was talking to a client just the other day, and I asked, what were you earning when you first started as an apprentice? This was 50s, 60s period of time. Not £10 a week. I wasn't earning £10 a week as an apprentice in those days. I think it was £8 a week was the number that came back. £8 a week, first job. I remember YTS for myself, youth training. I was on that for a while because there was no jobs, 3 million unemployed when I left school. Most of my mates went straight onto the dole queue. As we left school on the Friday and they signed on the Wednesday. I was just fortunate that I had a job to go to because I'd been working since I was about 13 anyway. But they did really well. I was a second chef in a restaurant at that point for £25 a week. £25 a week isn't going anywhere these days, is it? I was just pleased to be earning, to be honest with you. So inflation will in turn increase your wages. So we've seen that, particularly with the increases in public sector wages over the last few years. They went through yonks, years of not getting any pay rises at all. And we're saying, well, hold on a minute, we haven't had a pay rise forever. But without saying the wrong way, you need a pay rise either because you're doing more work and you're doing a better job, or because the cost of living is actually going up. That's what the pay rises are about.
When we talk about the interest rate
goes up, sorry, just before we finish.
Yeah, sorry.
The more that cost of living goes up, the more the people demand to get a pay rise, and therefore you end up in this cycle over and over. Sorry, back to you, Melvyn. You were going to say.
But talking about the interest rates, when it comes down to people who, we talked about the housing market, for those people who've got a mortgage, they'd rather the interest rates were down. If you're a saver, you want a better interest rate for your savings, don't you? It's another balancing act, isn't it?
Yeah, the key most of all, and what we speak to our clients about a lot, is trying to at least match inflation, preferably beat it. What you're looking for is a real return. Now, where that's all a bit messed up at the moment, again, it wasn't, but it is again now. We've got inflation at around about this 4%, irrespective of what you've been told on the news. proper inflation with our housing costs and RPI based, 4.5% kind of numbers. But now you look at some of the big building society standard instant access accounts, they're back down now to the 1%, just over, sometimes just under. They've really been pushed down over this last 6 months or so. A high flying rate at the moment is 3 and a bit, 3.5% in a bank or a building society currently. Well, if inflation's at 4.1 just for normal CPIH, which might be a bit diluted anyway, or RPI at 4.6, well, then you're only making 3.6. Well, you're 25% underwater on that. You need to try and get a better return. That's what ends up pushing people into being more proactive about their cash and their savings and their life savings to invest in stock markets that can go down as well as up, and other areas where you can try and get a better return, whether it be property or fixed interest funds or stocks and shares or commodities. It's about trying to keep up or preferably, wherever possible, beat inflation over the longer term. And we're back to that point now where cash and society might not cut it again.
You've just been on holiday. I had a holiday a few months back as well. Do exchange rates ever affect, where we are in the marketplace at all?
Yes, they do. And weirdly, it can often work the wrong way to what you expect it to, particularly if you've got invested assets. So I'll give you an example. Remember the Brexit debate. And we're not going to have a discussion whether it was right or whether it was wrong. It happened. That's where we are, and that's wrong. And there was a lot of, I think, scaremongering. There was a lot of fear being thrown out on both sides of the fence. If we come out, all this is going to go wrong. If we stay in, all this is going to go wrong. And it was really difficult for the general public to even get to grips with what might happen. One thing that did happen when that decision came through is the pound lost value. So effectively, the amount of euros or the amount of dollars that you get for your pound, you needed more pounds effectively because it was weaker as it was. What most people didn't realize at the time is if you were invested in big companies, even big FTSE 100 companies that have got global exposure, or you had investments in, say, Europe or America, when the value of the pound goes down, the value of your investments in those other areas of the world potentially goes up in value because they're worth more. Well, we've still got the second most valuable currency in the world. The only thing that you get that there are more pounds to them is the Kuwaiti dinar. So it's 3 and a bit pounds to a Kuwaiti dinar. Everything else, everywhere else you go in the world, you will get more of them to your £1. So $1.30 odd cents, for example, to £1. €1, 10 cents, 20 cents, whatever it is, to £1. That means that the pound's still a strong currency. So we're still, in comparison to other areas of the world, we've still got a very strong currency as it is. But there is always the issue that if you keep lowering interest rates, printing money, whether it's pounds, dollars, or euros, you live with, that's whatever your natural currency is at home, it becomes worth less when they lower interest rates and print more of it because there's more of it in the world. That's what caused all of our inflation back in 22, 23. We got up to 14.2%, I think it was, off the top of my head, around the end of 2022, inflation over a year period. That was chunky. Why? Well, it wasn't, don't get me wrong, some of it would have been to do with not being able to get stock from China or Europe and everything all being closed down, and there was more demand but less supply because the boats weren't coming with all the stuff that we needed. So if you've got 5 widgets on the shelf, you might be able to sell them at 20p a widget, but when you've only got one left, it's highly likely that you might be able to sell that one for 40p a widget because that's all there is. So there is that supply and demand issue. But actually, I think there was more going on than that. all the printing of money that was going on here for furlough, and it was just printed money, and all the printed money that was going on in the States at the time, they were sending out checks to households. That's inflationary. You're devaluing the currency. The cost of stuff goes up. Hence, we've seen over the last few years, particularly assets like gold. Gold's on a huge run. It's like it was back in 2008-9 during the credit crunch period. It's had a massive run, and I'm pleased to say that we've got exposure to that asset class within our client portfolios across the board, and they've done really, really well out of the gold exposure over the last couple of years, because the value of the currency that we're all spending has been going down all the time, and that's essentially what causes inflation in the first place.
When you mention gold, I tend to think of all these gold bars stashed somewhere in the Bank of England. I mean, so that will be doing well then, won't it?
Well, we haven't got any left, hardly. Unfortunately, it was sold off. 90s, I think we've got 310 tons now, which isn't a deal. And that was a decision by the Chancellor of the time. Decided that he would sell all the gold off, but just to make sure he got the price as low as he could do, he also made sure that everybody knew that he was about to sell reserves off as well. So unfortunately, no, we probably have, we've got more other people's gold in the Bank of England than our own, chances are at the moment. So yeah, we haven't noticed it quite so much, but people that have, for sure, Asia and the BRICS nations, the central banks and Eastern European banks, the central banks around the world have been buying gold hand over fist over the last couple of years, which has helped to put the price up.
Well, I do a bit of work for an auction house, and I've seen things like gold sovereigns. You know, you sort of think, oh goodness me, and it's been going up and up and up. So if you've got something like that you're sitting on, you're okay, aren't you?
Yeah, it's helpful. One of the advantages with sovereigns as well is that it's legal tender, so there's no capital gains tax on that. So you can have a gold sovereign that you bought 10 years ago that's now trebled or quadrupled in value since you bought it. And is there any capital gains? No. Could you take it to the shop and buy something with it? In theory, yeah, as long as the person behind the counter is prepared to take it. But in theory, yeah, absolutely you could, because it's legal tender and there's no capital gains.
I'm just going to look in my drawer to see if I've got one.
Yeah, just have a look in your drawer, yeah. The difficulty...
But again, it's deciding when you sell something like that, isn't it? As it is with any market, you know, you might have something, oh yeah, the gold price has gone up and up and up. And if you're sitting on that, you're then thinking, well, actually, shall I sell it now and take that profit, which we'll talk about later on as well?
Yeah, it's fairly easy most of the time to know when to buy if you're courageous enough to do so. The time to buy is when everybody else is selling and when everything's gone down. So we know instinctively that we should buy an asset at a low price and sell it at a high price. General public don't tend to get that round the right way, to be honest with you. And it's all to do with emotions. What tends to happen is that when everything's looking brilliant and really, really well, and wow, look at the way gold's gone, look at the way the markets have gone, look at the way this has gone, and it's gone up and up and up and up and up, and it just seems as though it's going to keep on going forever and ever and ever. People often wait until the last minute and then jump on the bandwagon and say, oh yeah, that's absolutely superb, I'm going to get into that. And then they're really upset when it drops 25% in value afterwards. So emotionally, sometimes people get it wrong for that reason. The other thing that people do, and again, this is just quite normal, the other thing that people do is they see an asset that they've got and it's growing, and then they're reluctant to sell it. Oh, it might have another 20% to go, yeah. And they don't want to sell it in case they miss out. It's a fear of missing out, FOMO, as it is, and it can be quite difficult to just make the sale and say, right, I've made some profit. The easiest way I always suggest to it, and I got this bit of advice from a fund manager who'd been running money for 40 or 50 years, well respected, local chap, lived in Leicester, lovely fella. And he said to me, Ray, you'll never get the top of the markets and the bottom of the markets right. But if you can get within 10% of the top and 10% of the bottom, you'll always do okay. Don't be greedy. And I think that's the thing. It's about sometimes just not being greedy. And the decision as to when to sell is at what point does it start giving you a little bit of anxiety to say, this has done brilliantly well, will it keep on going? And if you're anxious about it, don't have to sell it all. You can sell some of it off until such a time that you can sleep at night with it. And then know, okay, if it drops 20% from here, I won't be upset. I've already taken my profit. Thank you.
We talk about sort of people perhaps being a bit cautious with the markets, but I mean, at the moment, certainly looking at things that I'm invested in, they seem to be doing quite well.
Yeah, markets are really running forward at the moment, particularly since the April lows. We've had a really good increase, and not just in the US. I mean, they were a little bit laggard in the first couple of months, but they've really picked up now as well. It's mostly to do with the AI revolution and the expectation of high earnings going forward. And these companies are investing in each other all over the place. Again, it's that analogy of the snake eating its own tail again, though. It's quite scary in the respect that NVIDIA, one of the or if not the biggest company in the world now, I think. They make all the silicon chips for AI. It's a really lucrative position, it seems. That company is now worth around 4 trillion. To give an example of how much 4 trillion is, the whole of the turnover of the UK, our gross domestic product, our GDP turnover, is 3 trillion. And we're a G7 country. So one company's shares now, it's putting the market value at 4 trillion. And there's just been a round robin of $100 billion worth of investment that's effectively come out of NVIDIA and gone via Oracle, another big tech company, and OpenAI, the company that runs ChatGPT. And this 100 billion's gone round in a circle, almost feeling like it's a recycling moment, so that in the end, OpenAI can spend another 100 billion back with NVIDIA, but that was its source in the first place. So the same money, but it's helping put the share prices up in 3 different companies because of all this investment. And we're now getting to the point where markets have extended so far over the last few months. We've had a really good run up over the last few weeks, and it feels a lot like the 1999 dot-com bubble. There are some differences, no question. Differences are that in those days, it was all about the anticipation of future earnings and what the internet was going to bring. And it did. There's no question about that. But the valuations got really extended. And this current climate, some of those companies are genuinely reporting really, really high earnings. But if we look at it over the long-term scale, I'm going to share my screen with you, Melvyn. I'm going to show you a graph and explain what it is and what it tells us at the moment as well.
We've done this, I think, isn't it? Very exciting.
It is on these, yeah. Right, so hopefully you can see that okay?
I can now, yes. Okay.
Right.
So it's steadily going upwards, but there was a peak, and then we've still been generally going up, haven't we?
Right. So what this is a price earnings ratio graph that goes over 150 years worth of history.
Oh, right.
So
okay.
This is the S&P 500, which is America's version of our FTSE 100, top 500 companies in America. Now, the majority of the uplifts that we've seen in recent years have come from a handful of companies, the Microsofts, the Apples, the NVIDIAs, Meta, Facebook, those kind of companies. And they've been really chunking forward because AI is going to change the world. In exactly the same that the internet changed the world. There's these positions in time where technological advances just push everything forward, and it changes the world forever. And we're in one of those positions again at the moment. And I am an advocate of AI. I think it will absolutely change the world forever. There will be good things about it, and there'll be some pretty rubbish things about it, but it will change the world. There's no question. So what we're looking at here is something called the PE ratio. It's an inflation-adjusted way of working out whether a share that you're putting your money into is expensive or cheap, essentially. The way it works is let's say you're going to buy a share for £100. You're going to pay £100 for one share in a company because it's a really expensive share, but you're going to pay £100 for it. And what you expect to see in earnings each year is a 10% dividend, a 10% return. So for every year that you own that share, if you carry on getting 10% year in, year out, and that's the expectation, the price earnings ratio means that on a 10% return, it's going to take you 10 years to get your pound back that you originally invested. Anything over that, after that's profit. But to get your you'll get your original £100 back, it's going to take 10 years. So it's a PE ratio of 10. If alternatively the earnings were 5%, so it's going to take now 20 years to get your pound back, the PE ratio would be 20. So if you're paying a lot for the share, £100, but only getting a 5% return, not a 10% return, that suggests that that share might be expensive. Doesn't always mean it. You can't always go with valuations with high earnings. If the company's generating really high earnings, it might well be worth what they're suggesting you've got to pay for it. But let's take a look at this over the longer term. And what you'll notice is that over the years, there's been a few really high peaks, followed by some really big drops. If I hover over these now, we start off, if we look at today, the PE ratio, i.e. you buy a share for £100, how long is it going to take you to get your money back? Across the broad market of the S&P 500, that's 40. So 40 years to get your money back. That suggests that maybe that share is quite expensive. As an index, that suggests that it could be expensive. There have been other times when it's been more expensive. Top of the dot-com boom, it got up to over 44. Top of the 1929 Wall Street, just before the Wall Street crash, it got up to 30. It's actually higher now than it was at the top end of what ended up being the Great Depression in America as well at the time. And then you see these corrections. Well, that's just going back to the norm. What is the norm? The norm is 17.29 over that 150 years. The expected reasonable value that you can put on a PE ratio for shares that you're purchasing is it might take 17 years to get your money back in the dividends. And that's normal. Right now, we're at 40. So to get back to the mean, it's got to come down quite a lot if it eventually goes back to the mean over the longer term. Here's the dot-com boom. Dot-com boom, 99, and then we had a correction. And over the next 2 and a bit years, the S&P 500 PE ratio came back down to 21. That actually wasn't back to the mean at that point, but it meant that the share prices is about halved. Possibly, in some cases, it would have been more. The bigger the value of the company and the more risky that company that you're investing in is, the bigger you'd have seen a drop. Some of those old tech firms in those days, in that first year 2000 or so, dropped by 70, 80%, and they didn't really stop dropping until early 2003 as it was. Then we had the uplift right the way up to 2007, and then the credit crunch came along. We got back up to a PE ratio of 27, and then the credit crunch came along and got us all, and we ended up down at this point then, 2009, again, springtime 2009, to a PE ratio of 14. That was a really good time to buy, but who wanted to? Only the courageous. Everything that was on the news was saying the end of the world is nigh. Share prices have dropped by 50%, and people were saying, get me out of here. I do not want to be in here. Those that had the courage and the foresight and the risk appetite to be able to do it, actually, at that point, that was a really, really good time to purchase. And there have been a few occasions over my 30-odd years where I've really scrabbled around for my own money and my clients that might want to take up an opportunity to invest at really low prices, because they don't come around all the time. I think there's been about 4 occasions when I've felt this is a really, really good time to invest, but it's when everybody else is running away. There's another Warren Buffett saying that you've heard me say before on here. When others are greedy, be fearful. We're now at greedy, I think. When others are fearful, be greedy. When everybody turns tail and says, I'm never going to invest in the stock market again, that's possibly when the best opportunities arise. Right now, at this moment, in early October, as we're recording this, to get back to the April low after the Liberation Day that we've been talking about with Trump tariffs when he first announced all those, would be a 25% drop in the American market. That's going to have a knock-on effect across everybody else as well, across the globe. And we would still be in what they call bull market territory with a 25% drop. Because a 25% drop would take this PE ratio, in theory, back to around 30. Well, it was 30 at the top of the Wall Street highs around that point then. And that would just be taking us back to April. To get back to a mean or an average of what it should be might actually be more like 40%, 45%, who knows? And that's why I think it's worthy being cautious. We've taken a lot of profits on client portfolios that have done really well over the last year, 18 months or so. And we've been cautious through that period as well. We've been fortunately in the right asset classes to be able to see some really good returns. And it does feel at the moment like maybe taking some profit and de-risking the portfolio would be a really good idea, but that's not going to last forever. There's normally opportunities come along, and they're normally when everybody else is looking the other way and even dream of investing in the stock market, they're often your best opportunities when things get really cheap. Who knows? I'm not saying there will be a correction. If there was, would it be terribly surprising? No. And I think that's the important thing to remember right now with where we are in the markets.
Are people still cautious at the moment with the world markets and the things that are happening around the world?
I think people, generally speaking, possibly not. I think people maybe aren't. Rephrase the question and ask me if I'm cautious. Yeah, I am. I am quite cautious at the moment. But I've seen this all before, and a lot of us have. Those of us that have been in this profession for decades, 33 years now, coming on to 34 now for me. I've lived through the dot-com boom. We've lived through the credit crunch. We've lived through Brexit. We've lived through the pandemic. These things happen. And corrections come from time to time. Why should this time be any different? There's no reason to suggest that it will be any different. I think we can have a good guess as to if we do see a drop in market values, how central banks and governments will try and tackle that. And it generally tends to be lowering interest rates and printing money, because they learn in the credit crunch that worked really well. The difficulty with that is if you keep devaluing your currency and lowering interest rates and the cost of living goes up, it is like the snake eating its own tail. You just end up going round and round in a circle. And think about what a house costs now to what it cost back in 1975 or 1980 or 1990. That's a product of things just keep going up and up and up, but they've all had corrections. Every asset class that you could possibly look at will have corrections from time to time. And so whilst people are still jumping on the bandwagon, there's a lot of FOMO out there, I think. There's a lot of people that are buying into markets because they just think it's going to keep going and going and going. And the AI revolution's going to take it all forward. That feels a lot like it was in 1999 to me when I first opened up Money Minder. And there was people wanting to buy into the old Aberdeen and Henderson global technology funds that had done brilliantly well. They've absolutely stormed forward. But what goes up must come down again eventually, and it's just when. So people possibly not cautious, and they're not getting to hear everything that's going on in the economy, I don't think, globally as well as domestically. Some of you professional investors like myself, yeah, I'm cautious at the minute.
Okay, you mentioned the home market, and of course, we'll be eagerly awaiting any news in the budget. Again, there's talk about, well, they've said they won't put taxes up, but it seems the other side of it is people are saying, well, they're going to have to put taxes up to pay for certain things. What's your take on it all?
Well, clearly the budget isn't working. Um, Rachel Reeves set herself some pretty strict rules about what she can and can't borrow. Nothing terribly wrong with that at all, until such a time that she's running out of money, but she's still got to pay all the government workers. It's not just what they do for the country and the running the swimming pools and the highways and all that kind of. It's not just that, is it, that they're paying for? It's also all of the public sector workers' wages and all those kind of things. So it's an expensive job. Running a country is expensive, and they've got the same expenses increasing as we have, because we want more money because our bread's gone up in price. They need to find more. Where are they going to get it from? The key that hopefully Rachel's trying to achieve at the moment, and the government are trying to achieve, is to spur growth, and they want to increase the productivity. And that, again, this isn't just the UK; it's globally. They're trying to increase productivity and increase the turnover. So, in which case, there is more tax paid by the companies, by the individuals, and wages going up are affordable, and there's more revenue going in. But that's really tough at the moment because people are finding it tough. And those people that are putting off a takeaway this weekend because the mortgage has gone up, or putting off a weekend away to see the family 200 miles away because they just can't really afford the petrol. That's money that isn't going back into the economy. Where could she raise it from? There's been stacks of speculation, Melvyn, over this last few weeks, and it's been going for a long while. That yes, she needs to raise taxes. Where she can get it from? The trouble is that some of those taxes will drive people away as well. So, for example, put a bigger tax on wealthy individuals. We're all quite happy with that. That was one of the things that most people are quite happy with. Oh, if you're worth billions, absolutely you should pay more. But they're worth billions, and they don't necessarily come from this country in the first place. So if they're not treated very well, where are they going to go?
Home.
Okay. Or somewhere else, because they're not treated very well. So and particularly wealthy individuals will find a way. If the tax burden's too high, they will find a way with their advisors and their accountants, or moving, they'll find a way to reduce the amount of tax they pay because they won't feel that it's very fair. So they'll just move. So you can end up putting on a wealth tax that actually ends up producing more, even though the thought pattern was that it would increase income for the government. But those particular people, not always, but those particular people have mobility. They can say, well, right, well, if you're not going to treat me well, I'll just move. I'll just move across to somewhere that will. So you'll see there are some countries out there, there's even websites dedicated to it. There are some countries out there that specialize in finding wealthier individuals, people that have maybe sold businesses or inherited wealth, whichever way around it is, that want to move to somewhere else that's got a better tax regime. And they specialize, like a travel agent, in picking up a whole family and a whole life to go across and move to another tax jurisdiction. And there are countries that will encourage that. Have
you got a Swiss bank account or whatever? But is Switzerland not the place to put your money now?
No, not necessarily. And we had Credit Suisse go bust a few years ago, didn't we, as well? I'm not saying it's bad. It's neutral, and it's not bad. But you can have a Swiss bank account regardless of whether you live in Switzerland or not. There are other countries that will encourage you to go. There was a thing on the news a while back about Donald Trump offering a gold card of some sort to get into the States, and it cost $5 billion, I think. It was. I can't remember the top of my head. It was 5 million or 5 billion. It was a lot of money. But yeah, if you've got one of these gold cards, come and live in America. We want you. There are other countries particularly in Eastern Europe and elsewhere, there are other countries that work exactly the same kind of principles, where you can effectively buy citizenship and have a tax rate of maybe 8 to 10% instead of what currently is, by the time you take into all the VAT and our national insurance and our standard tax rates and what have you, probably about 40% at the moment in the UK. It's about the highest it's been since the Second World War.
So if she's not going to tax the billionaires, where is she going to get the money from?
Speculation about a property tax, potentially a one-off property tax. You own some property, we're going to tax you on it, and you're going to have to pay us X amount of pounds, dependent on the value of your properties. They'll all have to be looked at. That's
even our own home that we're living in now?
No, not main residence. Well, that's not fair, actually. That has been discussed. Own residence as well, because they're looking to rehash all the council tax anyway, aren't they? Because the idea that the council tax doesn't work very well. There's people in very, or what were, up until perhaps the last year, 18 months or so, some very expensive properties in London that were paying very little in council tax. And why would someone in Lincoln be paying more than someone in London on council tax if it's based on property value? Because property values down there were a lot higher. So there's been speculation about that. But again, it's really difficult to police and really difficult to put in place in one go. The easy hits, which are difficult because she's promised she won't, the easy hits are income tax. But they made that pledge that they weren't going to do it for working people. They weren't going to put taxes up for working people, didn't they? But income tax going up across the board, that will hit working people, and it goes right against their pledge. The reason why the national insurance contributions went up for employers was because for some reason they decided that employers didn't count as working people. I know a lot of really hardworking employers. There's some that do.
If they weren't, they wouldn't have been successful business, would they? They've got to be
Absolutely,
working.
Yeah. It's not unusual for me to put in 70 hours, 80 hours a week. That's and there's a lot of people like you show me a successful business owner that's looking after a team of people and their clients and doing a really good job, that's got much of a work-life balance. They don't tend to have it. They tend to work to make sure that it's all. So to sting the employers the way they did last time round, understandably, didn't go down very well. And you're actually restricting the amount of money in the economy because it's coming straight off the bottom line and going straight to the revenue. Otherwise, that money might have been invested in new employees, pay rises for the workers. There's lots of other things that company maybe could have spent that money on, but now they can't because it's been taken away. It's effectively straight off their bottom line. But income tax, if she went back on her pledge, income tax would be easy. That's one that they've been talking about as well. That's an opportunity. One of the big speculations that happened last year, and it's happening again, I've just done a whole report about it, was pensions tax-free cash and getting rid of the pensions tax-free cash element for people. I honestly, genuinely do not think that's going to happen, Melvyn. There's too many people relying on their tax-free cash out of their pensions when they retire to pay off mortgage balances, and having saved for 30, 40 years into a pension to then be told that you can't have any of it out as tax-free cash at all, I think is just political suicide anyway.
At the moment, it's what, 25%? Is it you can take cash tax-free?
Up to a maximum, though, of just over 268,000. That's based on the last lifetime allowance. So that cap, as it stands, is in place, but it only affects people with more than £1 million in their pension funds, in their pension savings. So it could be an NHS pension scheme, a local authority pension scheme, a police pension scheme, a personal pension scheme, just pension savings as a whole. If the accrued value over all of your years working is more than £1 million, you are restricted to £268,000 worth of tax-free cash. Don't have to take it all in one go, but that's the maximum that you can have out in your lifetime. And they keep a tab of it. There's calculations that have to be done for the providers to keep a tab of it to make sure you don't go over that limit.
But she could change that, could she?
She could, but it's only been done 2 years ago. 2024, that all came into being properly. I think the pensions profession would have been really lobbying against any more complicated changes. We've got enough going on with the possibility of pensions coming into the inheritance tax loop in 2027. So they'll be lobbying against that happening, and I do think it would be political suicide to stop the pensions tax-free cash element. But what might be a bit more palatable is the people that get the majority of the tax relief in their pension contributions are higher earners. So we're talking people there that are paying 40% tax, even 45% tax. Some people, there's an element of earnings. If you're earning over 100,000 a year, and bear in mind, we were just talking earlier about a 37% increase in the cost of living over the last 5 years. So if somebody was earning 65,000 or 70,000, good wage 5 years ago, for that to be able to buy the same amount of bread now, it would have to be over 100,000 because the cost of living's gone up so much. So there'll be some people saying 100,000 earnings. Well, 5 years ago, that would have only been maybe 60, 70. Wouldn't have sounded quite so unpalatable for a big chunk of the population. It is. However, there's also the other side of that coin that can be argued, which is when you get to those kind of levels, there's a reason, whether it's from qualification, hard work, whatever. If we get to those kind of levels of salary, you've got a skill set that someone's prepared to pay that level of wage for. But when you get to 100,000, you start losing your personal allowance at £2. Every £2 over 100,000, you lose £1 of your personal allowance. So there's an effective tax rate then for 25,000 thereabouts for those earners of around 60-odd%. So it could be argued that those higher earners do pay a lot of tax already anyway. But what they do have the advantage of at the moment is that if they put some chunky money into their pensions, they can get tax relief at their highest marginal rate. Now, that can be really, really helpful. So they put, in easy terms, they put £600 into a pension, but they actually get £1,000 going in when you just consider 40% tax relief. And sometimes it can be more tax relief than that even. If the government were to change the pension tax relief rate and say, right, we're not giving 40%, 45%, we're not doing pensions tax relief at the highest marginal rate anymore. We're going to cap it. We're going to cap it to 25%. However, what we're also going to do for all the lower earners or the normal earners that are basic rate taxpayers, we're going to make it 25% for them as well. Now, that could be quite palatable. Just it's been floated before. I think it could probably sit comfortably for 90% of the population. 10% of the population that are earning really well. 90% of the population are normal kind of earnings and they're basic rate taxpayers. If they get pensions tax relief, instead of it being 20% as it is at the moment, there's a boost to that and they get 25%. That might encourage some of them to put some more into their pension. Oh, that's a good deal. That's really good. Equally, that could well save the government quite a lot of money for all these big earners that have been getting 40% plus tax relief. And who can afford to put loads of money in their pensions? High earners. Who can't afford to put loads of money in their pensions? Low earners. Who would you prefer to encourage to put money into their pensions? Lower earners that will need it in their retirement and hopefully give them a better retirement than they were otherwise looking forward to.
Just picking up, Ray, on something else with regards to tax, the ISAs have always seen as a good place to get tax-free savings. Could there be a change in that with regards to the budget, do you think?
That was speculated on heavily quite a lot last year as well. Yeah, potentially there could be, but I don't think it would necessarily be about reducing the amount that you can get into ISAs. I don't think it would be so much that, but I think there's a keenness at government level to get UK population to invest in UK companies, and that's doesn't when we're giving tax relief across the board and you can put your money in an ISA pretty much anywhere you like. You could have it in America or Europe, Far East, and emerging markets. You could have in ISAs, you could have all sorts of different assets and shares from all sorts of different companies, from all sorts of places all over the world. And there's a fairly good chunk of options available, and nobody directs you. Now, go back to the mid-90s, we used to have something called the personal equity plans. Some of the listeners and watchers of today will remember personal equity plans, affectionately known as PEPs at the time. £5,000 a year, but it had to go into UK-based companies. So what might be an option that hasn't really been spoken about, so this is a personal thing that I'm thinking that they could consider potentially, is if the government want to encourage us more into investing in the UK rather than elsewhere in the world, why not split the ISA allowance up into, for example, 10,000 a year that you can put anywhere you like, cash, America, Europe, Far East emerging markets, wherever else it might be, wherever you want it to be, and any shares that you want, fine. But the other 10,000, or maybe just 5,000, something that if you want to get tax-free return, investing at a tax-free return on it, it has to go into UK-based companies. Just like the old personal equity plan. That would be a way of helping to encourage growth potentially without having to put taxes up. Because if you can get the growth, you don't need to worry so much about the taxes. So if we were investing more into UK companies, and those UK companies were then able to spend more on staff, more on R&D, more on development, then potentially that could have the side effect of a load of money that was going off elsewhere in the world, coming back and being reinvested at home. And if you're getting full tax relief as you're a UK resident, to restrict you to put some of that money into UK companies doesn't sound a terrible idea.
We will see. We'll come back and we'll do another of our chats after the budget. But there's just one other little point I wanted to pick up on the tax side of things. What about keeping the tax rate at a certain level? I'm thinking of your personal rate, for example. What is it, about 12,000 at the moment? Yeah.
So 4,000. Oh, sorry. The personal allowance was frozen, and it in 2023. It doesn't change till 2028.
Right.
12,570. So if you earn more than 12,570, you're going to pay tax at 20% above that 12,570.
Yeah.
And it hasn't changed in the last 3 years.
But we've got a situation where the state pension's going up. We're going to get to a situation very soon that actually your state pension you'll be paying tax on, won't you?
Yeah, there was one of the very first conference that I saw with Rishi Sunak and Keir Starmer. Keir Starmer was they got quite passionate about it, and Rishi Sunak was getting quite pointy finger at Keir, saying that it would, if they got in, this government would be the first government to make pensioners taxpayers in history. And he obviously denied that would ever be the case. That wasn't going to happen. And it was all speculation. But in truth, that freezing of the personal allowance was already in before they had that debate. That wasn't a Keir Starmer thing originally at all. That was actually a Rishi Sunak thing beforehand. And because that freezing of the allowance is in place, you've now got a state pension, flat rate state pension of around £12,000 per year before you get up in the morning. The next increase is expected to be around 4.5%, and that will gobble up the majority of that extra £500 worth. And for some people that are getting a bit more than the standard flat rate, they're already being taxed on their state pension. But certainly, if it's not this year, it'll be next year, where I think state pensions, you'll have enough coming in that means that if you haven't got any other income, they're going to send you a bill once a year as well. It won't be taken at source. They always pay the state pension gross. But if you've got, let's make it easy, if you've got a pension in the next 2 years of £13,570 income from the state pension, not unreasonable, it could be there if inflation carries on the same as it is, you're £1,000 over the allowance. You owe 200, take it at source and say, here you go, here's your state pension less the £200 you owe us. they'll let the year go by and then send you a bill. And the January after that tax year is finished, you're expected to declare it and pay you £200. And so here you go, I owe you £200 tax. That's going to be a little bit disconcerting, particularly for some of the older retirees that have understandably kept away from tax returns and doing anything to do with tax since they gave up working 20 years ago. They won't be very pleased about that at all.
No, indeed, indeed. As I say, we'll come back and we'll talk more about that when we know what's announced in the budget. I want to just go back to something we've talked about the last two episodes, and America. We talked about Trump last time. Since our last chat, he's had a visit to the UK. But I wanted to really get your thoughts on whether the tariffs have had an impact, probably more on business here rather than the general public.
I think they've had an impact on all areas, but not quite as a demanding impact as what was originally being scheduled. So what was originally felt was tariffs put the cost of stuff up. It's essentially the manufacturer has got to pay a tax to the government for the people exporting the goods from one country to another, so there's an extra cost involved. So again, back to widgets. The company were able to build and sell a widget for £10. You then put a 20% tariff or a 10% tariff on top. They've got to pay that. There isn't enough profit left in it. If they still sell it at £10, they've now got to sell it at £11 or £12 because they've got to pay that tax on the way through. So the first person that would be expected to get the hit wherever they can on a tariff is the end user. I need a widget. The only place I can get it from is the UK or China or Europe or wherever else because they don't make it over here. I need that widget and the cost has gone up. I'm just going to have to pay it. But there comes a point where people just say, no, I'm not doing it. I'm not buying it. I won't buy that particular brand or I won't buy that particular version of that widget because the cost has just gone up too much. That ends up potentially being deflationary. There's often a thought, and there was probably a little one in America in particular when tariffs were first being bandied around, where you get an initial spike of because particularly with providers and distributors, for example, if you're buying loads of stuff in from China and you know the tariffs are going to go up 50% and your shelves are running a bit lean, but you've got a chance to stock the shelves up just before those tariffs start, that brings purchasing forward. And the boss says, right, we've only got 5 of those widgets left on the shelf now. We're going to sell 50 of them over the next year. I do not want to be paying the huge tariffs on it. Let's get them over now. Let's just bulk buy and we'll fill the shelves up. Anything that we can't get on the shelves, I'll take home and put in my garage because I want to buy them at the right price now. And for a while, that doesn't necessarily come through because they haven't had to pass that extra cost on. But there will be a time when that stock has run out. Then they're going to have to buy some more, and then potentially the cost goes up. And it's for the provider, the distributor, it's how much can they get away with passing on to the end user, to you as the purchaser, that will determine the price that goes on the label on the shelf.
Do you think the American buyers appreciated that when Donald Trump said we're going to put these tariffs on, blah, 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 it was going to mean that the American buyers would be paying more?
Some of them will have done, of course, yeah. But it wasn't the American buyers that were doing all the voting. Of course, it was American people that were doing all the voting. And the trouble is, you don't know what you don't know. So if you're being, and it doesn't matter whether you're in the UK, in America, in Europe, in Russia, you're led down the path of the rhetoric that you hear from your news stories and your media and the people that you believe. And for you, if you listen to someone talking and it all makes sense to you, that's how populism works, and it all makes sense to you, it's your truth, it's their truth, and you go, oh yeah, that's a great idea. And I think what was clever about the campaigning was Donald Trump was saying, how do you feel? Do you feel as though you're better off? Do you feel as though things are going really well for you? Do you feel as though everything's as good as it can be for you? No? Vote for me. I'll make it better. And we're gonna we're all going to be billionaires. America's going to be great again. And and people buy into that enthusiasm, don't they? Often.
They do. I think the thing you were talking about with your widget example, I think the idea is that eventually you'll be able to buy your widgets in America, that they'll be producing their own widgets. But that's going to take time, isn't it? And the same could be said of this country, that, if we're producing more of our things here, we won't have to import them. That's the whole nature of it all, isn't it?
Yeah, and it takes years. One of the shoot yourself in the foot moments for Trump in that first week in early April was that he wanted to put a load of tariffs on Vietnam, what they were producing. And Vietnam were producing all the Nike trainers, big American brand, Nike trainers. And they've got big glue factories and they pay cheap labor for people to build trainers in Vietnam. But if you put a big tariff on stuff that's coming out of Vietnam, then that's got to be passed on to the end distributor, Nike. That means that the cost of the trainers would have had to go up to cover the tariffs. And it was literally a shoot yourself in the foot moment for Trump. And Nike he did a deal with and said, "Oh, all right, because how do you overnight stop everything being made in Vietnam, where they're all trained and they know exactly what they're doing, and it's quite cheap labor, and the following month open up a new factory in Philadelphia that is now where all the Nike trainers are made." Logistically, it's an absolute nightmare. You just can't do that stuff overnight. It takes years.
And it's also going to cost more. Labor costs, production costs is going to be more. So the end product is going to cost more, isn't it? And you've got to know the consumer's prepared to pay that.
Exactly. And you've got to find a bunch of Americans that are happy to work in a glue factory all day long, which they might not. And that's not a terribly unreasonable thing to suggest. Do you want to work in a glue factory all day? Probably not. Not if I can help it. If I've got no other choice, maybe. You'd do anything if you've got no other choice, wouldn't you? I've always said you need to earn some money. You'll do whatever you need to do to earn it. But given the choice, you might not choose that lifestyle. So yeah, I think the tariffs have generated income. They are talking about new money coming into America, so they've got more money potentially to spend on stuff. But at the moment, the American government's closed down because they can't agree on future funding levels and the deficit, the clock, how much they're spending more than what they've actually got coming in. That's not getting any better at all. Elon Musk was brought in to be able to reduce the costs of running the country by $2 trillion a year. He was tasked to reduce the cost by. You might remember a speech that he did that was on the news where he came out with a big stainless steel chainsaw in front and said, "This is what we're going to do to the federal workers. So now I respect the local authority workers across the country. This is what we're doing to your jobs." It didn't go down particularly well, unsurprisingly. And so that $2 trillion saving didn't happen as it is. And now they're fighting over funding issues in the future, and everything's all closed down. And there's a load of people now, about 900,000 workers, I think, in the States at the moment that are on furlough. They're at home, non-essential workers. If you're in healthcare, security, that kind of different matter. But for the non-essential workers, they've all got a paid holiday at the moment on furlough while the government try and sort themselves out.
We'll come back to the UK for our next podcast, but if people want to know more or want to perhaps subscribe to this podcast, what's the best thing to do?
If you're watching this on YouTube, subscribe, hit the like button and the bell for the notifications as well. And anytime we produce a new podcast, it'll come up on your phone, on your computer to say, "New podcast from Moneyminder." That's the easiest way to do it. And if any problems with it, by all means, ring the office and we'll help.
Very good. We'll wonder whether we'll be smiling or having a sad face after the budget, but we'll find out. That's the joy of these podcasts, isn't it?
It is indeed.
Thanks, Ray.
Melvyn, nice to see you. You take care. Speak soon.